All right, we'll go ahead and get started. This is Chris Berry with Castle Wealth Group, and we do these wisdom webinars. Hello, uh, usually every Wednesday. And I'm a certified financial planner, CFP, and certified law attorney. We just log in and answer questions that have been submitted ahead of time or submitted while we're on the call today. And I always start with a positive focus, just something positive that's happened over the last week or so. And positive focus is my daughter had a indoor soccer game last weekend, played really well, and really exciting is outdoor soccer is starting tonight. So we have a first practice, and I coach her on soccer. So that's kind of fun. So with that, if you do have a legal, financial, tax planning question, feel free to put it into the Q&A. And I apologize. Normally we have them recorded. I forgot to hit a button last couple times, so they haven't been recorded. But now they will be up on our YouTube channel if you ever miss one or want to watch a previous one or review what we cover. So with that, I didn't really have anything submitted ahead of time this week, so I was just going to share with everything going on in the markets. Uh, there's been, as of today, like a lot of news uh, from the time this presidency has started in terms of tariffs, executive orders. And you see tech stocks kind of taking a tumble, Nvidia. So a lot of people, a lot of the conversations we're having, even conversations today, were just about, is my money safe? And so the answer to that is it depends on how things are invested. So I just got off a call with a client, and we had put some of her money into things that have principal protection. So there's downside protection. And then even what we have in the market, there's ways, even if we're tracking things like the S&P 500, keeping things liquid, where we can have still downside protection. We can build in buffers. For example, what we call buffered ETFs, where they can protect against the downside to a certain extent, but there's a cap on it. And so a lot of times we can put a few of these together in one portfolio so that we can protect against some of the downside, but still get a good rate of return and keep it completely liquid. So understand now's the time we start looking at some of these types of tools. If you look at your portfolio and you're thinking, hey, I don't like seeing it going down, because it's been very easy when everything was going up to just say, hey, I'm aggressive, I'm aggressive. But what we see is the market actually goes up and down over time. Typically, it goes up. Um, and what I wanted to do is just share uh, something I saw from one of our research partners, um, and understand that we've had this little bit of downturn. Things are up a little bit today. But the question is this going to be just a blip, or is this going to be the start of something where it could get worse? And to be honest, no one really knows that answer. But I did want to share something that I found interesting if you zoom out looking historically. And again, we can't always look necessarily to the past, but there's saying history kind of repeats itself. So I'm going to share my screen real quick. And really, what we're talking about here is just uh, looking at the S&P 500 and understand that on average, um, and this was compiled, this is from, looks like 1928 to 2024. So looking at the S&P 500, if there's been a 5% dip or more, about every 3.5 years, or about 3.5 times every year. Okay. So understand that, like, even in up years, a lot of times we will have maybe a little dip, maybe a 5% dip. And then we look at moderate corrections, 10% or more. Typically, we have that about once a year. Um, so understand that, hey, maybe we've gotten that out of our system already this year. Severe corrections, about once every 2 years, and then bear market, maybe once every 3 years. And again, this is going way back, all the way back to 1928. So um, I don't think it's a time to panic right now, given that. We don't necessarily know if this is more of kind of a sentiment to all the actions that are taken, or if this is going to be more of a long drawn out thing. But understand we're watching it, and what we're suggesting is reviewing your portfolios, reviewing how much risk you're actually willing to take on. If we haven't uh, had a conversation about risk score and volatility, it might be a good time to just rethink looking at, hey, how much risk versus reward do I have in my current portfolio versus how much am I really willing to take on? Because in reality, if you look at it last couple of years, we've been on a big upswing. And even as I review things with our clients, we're doing our reviews. If we zoom out more than just year to date, things are still up. I had a conversation with a client today. We were down 2% year to date, but if we zoom out over the last year, we're still up 8%. So sometimes it's helpful to zoom out, see the big picture, not get wrapped up in short term, but understand that the short term could turn into long-term things. So it is a time to be cognizant of what's going on, but really it's not necessarily a time to, I wouldn't recommend panicking, selling everything off, and putting everything into the mattress, so to speak. So I found that statistic interesting, is that usually about once per year, we do have a 10% dip. And again, over the last couple of years, things have been shooting up. So we haven't experienced that. But now that we see a little bit of a dip, you might want to ask yourself, am I comfortable with this? Am I comfortable with the amount of risk I'm having or seeing in the portfolio? Because now we're seeing the risk for the level of aggressiveness that you may have in your portfolio. And then the other thing to think about, and I've touched upon this a couple times already, and prior to kind of all the craziness in the world, we thought this was going to be one of the big themes for 2025, is looking at incorporating alternatives into the portfolios. So what we saw in the last dip is stocks and bonds are more correlated than we think, where if stocks have dropped recently in the past, so have bonds. So everything's kind of went down. So the key is looking for non-correlated assets. And that's where alternatives can play a piece of the puzzle. I'm not just talking about gold. I'm talking about other things like private equity. I was having a conversation with a client looking at like buying up student loans, things like that. There are multiple different types of investments. Some of them like even investing in sports teams. Now, depending on your level of net worth, you may have some limitations on what type of investments you can or what type of alternatives you can invest in. But it is something to consider, especially with the larger portfolios, is maybe not just looking at the classic like 60-40 stocks bonds. Maybe we want anywhere from like say 0 to 10% in some type of alternative. So that's another way that we can kind of ride out the storm a little bit to build in more non-correlated assets. And then the last thing to think about is right now interest rates are still relatively high. For example, our high yield savings account right now is at about 4%. Now things may change. They're talking about when the Feds meet again of lowering the rates, which would lower the rates for CDs, lower it for mortgages, lower it for the high yield savings accounts. But right now I do have clients sitting on cash, just kind of waiting to see how things play out. So just those are some ideas with market volatility. That's really all I had to share. With that, if you do have questions, feel free to shoot over an email. We'll address them on the next call. But thank you, everyone. Make it a great week. Take care.